It is almost 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Here are the top stories. China said to be looking at around $850 billion in special bonds and even taxing the ultra-rich to raise funds to boost the economy. But investors seem unimpressed. Bloomberg learns that the U.S. is weighing capping the sale of AI chips to some countries, broadening restrictions beyond just China. And we're joined exclusively this hour by the CEO of India's third largest IT firm, HCL Technologies, after earnings beat expectations. We'll discuss the risks and opportunities he sees ahead. Well, the U.S. lifting sentiment here in Asia. We have the S&P hitting yet another record level. I think, Avril Hong, we're losing track of that already. 46th session, I think.
Yeah, I mean, given the number of record highs we've seen this year on the S&P 500, you would think maybe it's time for a cooling off. But no, this is what we've seen on Wall Street overnight. And to your point about how it's lifted sentiment in the Asia Pacific, mostly higher, including in Japan, that has returned from a long weekend, helped in part by the weakness that we've been seeing on the Japanese currency. But there are a couple of outliers to this climb we're seeing in stocks today, as we see the energy sector, the underperforming one, the worst performer, as Brent and US crude futures fall about $3 a barrel. We are also keeping an eye, of course, on what we're seeing in the Chinese stocks, but the Brent prices, of course, have been coming down amid the reports that Israel may not hit Iranian crude. Now, as to China, we heard from the likes of Tyson saying that Chinese authorities could raise about $850 billion to boost growth, and this could come in the form of ultra-long special government bonds over 3 years. But look at the stock market performance, both on the CSI 300 and the Hang Seng. Investors seemed underwhelmed. Now, the dollar is showing some strength. The other thing we've been watching is what we've been seeing from these Fed speakers. Have a listen.
This data is signaling that the economy may not be slowing as much as desired. While we do not want to overreact to this data or look through it, I view the totality of this data as saying monetary policy should proceed with more caution on the pace of rate cuts than was needed at the September meeting.
Today, monetary policy remains in an overall restricted stance, though just how restrictive is somewhat unclear to me. Ultimately, the path ahead for policy will be driven by the actual economic, inflation, and labor market data.
Fed speakers there sounding a bit cautious on rate cuts. But of course, as I flagged a short while ago, what we're seeing is the underperformance in Chinese equities not helping things along. Data that we got in the past day on credit out of China, which show new yuan loans that missed estimates. It tells you how weak domestic demand is, even though we did see the aggregate financing broad measure of credit exceeding expectations. This was mostly from government bond sales. It just shows you what is needed in terms of stimulus for China, Has.
That's right, and what's needed to lift the economy, which has been so sluggish for so long. Avril Hong, thank you so much for that. Well, China looking at different ways to raise funds for its big stimulus push. Bloomberg's been told Beijing is now enforcing a long-overlooked tax on overseas investment gains by ultra-rich. Reports also say authorities plan to raise close to $850 billion through long-dated debt. For more, let's bring in our China correspondent, Min Min Lo in Hong Kong. And Min Min, of course, this is about boosting revenue, and there's a sense of urgency.
Yeah, this is a long overlooked tax that China is apparently now enforcing. As far as we know, some Chinese wealthy individuals in major Chinese cities have been asked to conduct self-assessment, or they have been summoned by the tax bureaus for meetings to evaluate potential payments, including those in arrears dating back years. And these Chinese individuals could face levies of 20% on their overseas investment gains, plus penalties on overdue payments payments. And according to sources, the final amount could be negotiable as well. And this shows the urgency of the Chinese government in finding alternative sources of revenue, given that fiscal revenue has contracted in the first 8 months of this year. Government land revenue falling by 25% in the first 8 months of this year. Tax revenue as well falling by 5.3%, I believe. And it also kind of dovetails with President Xi's Common Prosperity campaign as well to reduce that income gap between the rich and the poor that has seen some multi-year campaign in cracking down in various sectors of the economy, including the property sector, the financial sector, the consumer internet sector, and it looks like now wealthy individuals are now under the spotlight as well.
That's right, and China also looking to raise funds via ultra-long bonds, and we're looking at possibly $900 billion.
Yes, this is according to Chinese financial media Caixin, saying that the government is looking to issue 6 trillion yuan in these ultra-long special government bonds over a period of 3 years. Now, markets had been expecting about 2 trillion yuan in additional fiscal stimulus. So this is largely in line with market expectations. The fact that it is a multi-year stimulus plan that could restore some confidence among investors. But it looks like investors are not entirely impressed. Perhaps this news is also overshadowed by the weakness in the economic data, the inflation data that we got, as well as exports data that was much weaker than expected, and the credit data as well that Avril was pointing out earlier. Now, according to Caixin, this 6 trillion yuan in additional stimulus, a part of that is going to fund, to tackle local government debt. And we know the Ministry of Finance had said they're going to allow this one-off increase in local government debt quota by a relatively large amount to swap out these tens of trillions of yuan in off-the-book hidden debt. And that would free up resources for the local governments to shift attention from repaying those debt to actually increasing spending on the economy to revive growth.
That's right, fundraising to perhaps spend more on the economy. Bloomberg's China correspondent Min Lo, thank you. Let's get more on China's latest policy measures with Mark Franklin, Senior Portfolio Manager for Asia Asset Allocation at Manulife Investment Management. Mark, when you take a look at the trading in China right now, CSI 300 down 0.6%, pretty choppy trading. Investors trying to decide how long that rally may last. Well, not today. How are you looking at it?
Good morning. It seems to be the case that expectations now are set higher than they were a few weeks ago. And therefore, the Chinese government and policymakers not only need to provide concrete numbers, but also a credible plan, which, as you say, provides for stimulus which can work over a multiple-year time horizon. The reality is, whether the number is 4 trillion RMB or 6 trillion RMB, it's a much smaller percentage of potential GDP creation compared to the bailout packages and the stimulus packages that we saw in 2009, 2010. At the same time as well, the recent data that we've seen in China continues to indicate a very, very suppressed cyclical picture. Export growth anemic, bank loan growth pretty shallow as well, consumer household sentiment, business investment sentiment subdued. It's going to take not only a larger sum to really drive market sentiment higher from here, but also more tangible measures which actually find their way to the end consumer. And at the same time, the fiscal stimulus room on the balance sheet of both local as well as central government is in fact limited. I think Hangzhou, the tier 2 city a few days ago, announced a consumption voucher stimulus program which equated to about $7 to $8 per person of the local population, which really doesn't get you much more than buying a cup of coffee. So it highlights that there's a certain degree of strain on the balance sheets of both local and central governments, and therefore a larger number is required to give the market confidence that they'll be able to take themselves out of this cyclical lull.
Right, so you say fiscal headroom is pretty limited, yet the likes of Goldman say there's still 20% upside to this rally in China. How do you square that?
If you look at valuation multiples, even after the rally that we saw a couple of weeks ago, which has retraced about half of that, valuation multiples are still very, very discounted. So it's quite conceivable that sufficient confidence comes back into the market. And all valuation multiples need to do is get back to sort of peak levels ex-COVID over the last 10 years, even in the absence of a major macroeconomic upturn. So it's really about the risk premium coming in And in order to get there, investors need to have a high degree of confidence that the measures that will be announced will be sufficient to drive the cyclical pickup in order for the government to reach its year GDP growth targets and beyond.
So would you be a buyer if we see a further dip in the market in China, Mark? Because if you take a look at data, fundamentals are not looking promising at all.
2 points that we're looking for. One is a strong pivot towards stimulus that finds its way directly to households and consumers. That will be an acknowledgement that the growth drivers for the economy need to shift compared to the legacy model of fixed asset investment and effectively infrastructure spending via local provincial government. So much more stimulus directed at the households, but also acknowledgement that they are unleashing the private sector to start innovating again. If you look at the number of new private sector startups that have been founded and opened up in the last couple of years, it's been a significant drop compared to the previous 5 to 10 years. So unleashing the private sector's innovation capabilities is essential, and directing the stimulus much more closely towards the households and away from the local governments will get us much more enthused, because, as I mentioned, there is definitely a valuation catch-up which is still potentially on the table for Hong Kong, China markets.
What's the biggest risk for the China market right now? Further disappointment, you think?
It's really a perception that the risk premium for overseas investors deploying additional capital into China remains elevated, whether it's because of geopolitical tensions, political shifting sands, or a lack of follow-through from the recent announcements, both at the financial markets level but also at the end spending level, that it's not really coming through in the data. So we'll get the October data in mid-November for China. If there's limited evidence that the measures that have been announced so far are really helping the data to improve, then that will lead to a further bout of profit-taking for those investors that were early to participate in the recent rally.
Mark, I'm just wondering how the PBOC is looking at the Fed now. The expectations that there could be a smaller increases from the Fed. Might that, make the situation in China just a tad better?
Well, it's no coincidence that the coordinated stimulus announcements came after the Fed commenced its rate-cutting cycle in mid to late September. So it's definitely the case that the PBOC watches the US Federal Reserve very, very closely. Ideally, what they're looking for is a further moderation in the pace of appreciation of the dollar, or in fact some weakening of the US dollar, which will give the PBOC and other policymakers confidence that should they ease both monetary and fiscal policy, it won't lead to capital flight from China, and that the CNY will remain anchored in the crosses against the dollar and other major currencies as well. So they will be watching the Fed quite closely, and the extent to which a more moderate pace of cutting from here on in, either that appreciates the dollar or ceases the recent depreciation that we saw up until the last few days.
Mark, hang tight. Mark Franklin of Manulife Investment Management is sticking around. And still ahead this hour, our exclusive conversation with HCL Tech's CEO about their corporate outlook after second quarter results came in above estimates. Plus, Bloomberg learns the U.S. is discussing new restrictions on sales of advanced AI chips. We'll have more on our scoop next. Keep it here with us. This is Bloomberg. Welcome back. And Bloomberg has learned that the U.S. may cap sales of AI chips to certain countries. The move could limit artificial intelligence capabilities in places like the Middle East. For more on our exclusive reporting, let's bring in our tech reporter, Annabelle Drulis. And Belle, how much more do we know? When might that cap be implemented?
Well, at this stage, the conversations are certainly fluid and the details, of course, could change. But what we're hearing from our sources here is that the Commerce Department in the US is essentially looking at further expanding the framework that's already in place. It's called the Validated End User Program, or VEU program, and so it restricts exports of certain high-tech technologies to places like India and China. Last month, that mechanism was amended to include data centres, and now we're hearing it could be used to restrict exports of AI chips to places like the Middle East. The concern with the Middle East in particular, even though we have seen the US and the UAE at least putting out a joint statement on their shared ambitions around AI technology and also their shared acknowledgement of how it could be used for the bad. But essentially is because the Middle East does have a growing relationship with China in particular, and there's that broader concern around this, that even if you do restrict technology exports to places like China in particular, chips can still find their way to the mainland through these third-party countries, and that includes the Middle East. It does have that growing relationship with Beijing as well.
Belle, export licenses might perhaps be a point of leverage?
Yeah, that's right, and that's certainly how we're sort of seeing them being used, because the US can put pressure on companies and also governments in other places outside of the States to restrict or to amend their relationships with China in order to gain access to this sort of technology. There is that concern, of course, that the US doesn't want to risk falling behind in the AI race, or risk having its most advanced technology that's developed in the States used against it in turn, because, of course, other companies outside the US can continue to grow their AI capabilities with this sort of technology and then use it against the US. But certainly there's that concern around how would the chip makers like NVIDIA, AMD, Intel react to these sort of restrictions as well. And we've already seen, for instance, when those curbs were first put in place targeting China in particular, NVIDIA did actually manage to make certain modifications to its semiconductors in order to be able to continue exporting not perhaps the most advanced, but still advanced technology to China. So, yeah, that question as well. How would they go around the restrictions, or how would they react to the restrictions? It's certainly going to be something that could end up being quite difficult for the White House to enforce, and something that could actually be quite difficult to bring in before President Biden's term ends in just a few months from now.
Belle, thank you so much for that. Bloomberg tech reporter Annabelle Jewellers in Sydney. Let's get more analysis now on that, especially on the back of those geopolitical risks as well. Still with us, Mark Franklin, Senior Portfolio Manager for Asia Asset Allocation at Manulife Investment Management. Mark, your first reaction to that scoop out of Bloomberg, I mean, the U.S. considering perhaps banning those AI chips to some countries.
It's counterintuitive, actually. The more the US potentially announces additional restriction measures, the more you're likely to see inventory build and a spike in near-term demand by end customers for these high-end chips, on the logic that if this measure gets released now, then what will come further down the line? So let's hoard and build up our inventories now, just in case it genuinely becomes difficult to source them in the future. So counterintuitively, this is actually a bullish catalyst for the semiconductor sector in the short term.
How do you play it best?
Well, we like the fact that technology, during the period in the US equity markets in recent weeks, had a bit of a lull in relative performance. There was a bit of reorientation, sector rotation in the US equity market, which created a bit of a time correction for some of these high growth, more cyclical tech sectors. So it's created a bit of a relative buying opportunity on a tactical short-term basis. So we wouldn't really look beyond just playing it via the broader semiconductor complex.
Mark, the tech risk is part of the geopolitical risk that we see as we count down to the U.S. election. With volatility expected to increase, what's the best trade out there?
There's a couple of potential ways to express the view, which is to say which asset classes would present a safe haven on a both cyclical and a secular basis. And one prime candidate for that is gold. So gold benefits from the perception, correctly or incorrectly, that increasingly loose and risky fiscal policy in the US and other economies as well is effectively undermining the value of fiat currency. And therefore, a store of real value in the form of gold, but dollar denominated, should perform very well if you believe that on a bipartisan basis, there's no longer a fiscal conservatism element to the US political scene. So gold performs very well from a fiscal policy perspective. It also performs well in a heightened geopolitical framework perspective as well, because what we've seen in recent months and years is that various governments have been building their gold reserves in anticipation of an increasingly unstable world. So we like gold from that perspective. And then some of the undercurrents of an increasingly bifurcated global economic system are those economies that hitherto benefited from strong technology advantages which are starting to be eroded or are losing out to an increasingly mercantilist China. So we look at the core Eurozone. It looks like Germany's experiencing a persistent bout of deindustrialization here as it loses competitiveness either via cheap energy feedstocks or in the higher-end industrial complex as well. And at the same time, if you look at France, it's going through a period of budget excess, and the requirements for the ECB to cut rates become increasingly pressing. So we like to express a more cautious structural view as a result of geopolitical dynamics via a pessimistic outlook for both the euro and the core Eurozone economies relative to the US and relative to certain parts of the emerging market complex as well.
Mark, before we let you go, just a question of the day for you. We're seeing the yen inching ever closer to 150. When might we see the next intervention in Japan?
Certainly not before the US Federal Reserve next meeting and the US election as well. One of the things that was pretty evident was that both the Bank of Japan and the Ministry of Finance got rather spooked by the rapid appreciation of the yen across August and September. They didn't like that because it led to a rapid loss of competitiveness for the exporters in Japan. So they basically took their foot off the pedal, both rhetorically and literally in terms of further policy normalization. So they'll wait and see now whether the US Federal Reserve cuts again in November, which is the base case, or whether they stay on pause in light of the recent improvement in the US economic data. If the yen weakens further from here, what you're likely to see from a communication perspective is the Bank of Japan potentially put another rate hike back on the table in the coming meetings in Japan, which will allow them to further normalize policy. If you look at market pricing, one-year interest rate swaps in Japan do expect another 40 basis points of rate hikes in Japan over the next 12 months. The question will be whether that's front-ended or back-ended in that period of time.
We're keeping an eye on energy stocks on the back of oil extending losses after the Post reported that Israel doesn't plan on striking Iranian oil or nuclear facilities. OPEC earlier downgraded its oil demand projections for the year as well as for next year as well. As oil Corp currently down by almost 3%. CNOOC also trading negatively in terms of New York crude trading at 71.62, down about 3% right now. We're also tracking Asian chip stocks on the back of that Bloomberg scoop saying that the U.S. is weighing capping NVIDIA as well as AMD's AI chip sales to some countries, and that includes the likes of the Middle East, and that's according to people familiar with the matter. Tokyo Electron, though, still trading up by 5%. SK Hynix also in the positive. Still to come, China's latest stimulus push has Goldman Sachs turning more positive. Keep it here with us. This is Bloomberg. Well, Japan is just about to come back from lunch break. The Nikkei 225 in positive territory today, but it is about the yen inching ever closer to that 150 level. Avril Hong is in the Lion City. Avril.
Absolutely. Those levels you're seeing, something we have not seen since the August yen carry trade unwind around the 150 level. And it looks like it is nudging close to 150. And this is, of course, against the backdrop of Fed as well as BOJ policy expectations, when you have the likes of Christopher Waller, Neil Kashkari urging a bit of caution when it comes to Fed rate cuts, and on the other side, the Japanese Prime Minister seemingly having convinced or persuaded the BOJ Governor Ueda to wait a little while when it comes to rate hikes. Maybe not this year. So this is the setup that you're seeing on dollar yen. And as you're saying, Has, where we've seen the Nikkei and how it's breached that 40,000 level, that's something we haven't seen since July. Let's flip the board and take a close look at it as we've come back from the lunch break in Japan. And in the Nikkei and the topic, some of the stocks, if we can flip the board, that we've been seeing gaining ground today, tracking the climb in their US counterparts, are the tech and the cyclical names. Investor sentiment boosted in a way by what we're seeing on Wall Street as investors look ahead to those earnings releases. They seem to be banking on positive surprises. Now, so this is what you're seeing coming back from the lunch break on the Nikkei, extending the climb of earlier in the morning session. Let's flip the board again. You've just seen there this Bloomberg scoop, how China banks are mulling cutting the deposit rates as early as this week. This latest development might be the latest key when it comes to some of these stimulus measures and efforts that are being announced or potentially being mulled by Chinese authorities. Of course, earlier we've heard from the likes of Tyson and how it reported that Chinese authorities could also raise about $850 billion from ultra-long special government bonds in order to boost growth. So far, the investment community has been pretty split as to the developments over the weekend from that finance ministry briefing. We have Morgan Stanley, Wells Fargo saying steer clear of Chinese stocks. They've been saying, they're running ahead of reality, but we also have the likes of Goldman Sachs saying that whatever's come so far is a bit of a turning point, Has.
That's right. Once again, just to recap the breaking news that we have, China banks mulling cutting deposit rates as early as this week. Let's bring in our guest. Hui Shan is Chief China Economist at Goldman Sachs. Hui, your thoughts on this breaking news? According to people familiar with the matter, China banks mulling cutting deposit rates as early as this week. Is that a surprise?
Thanks for having me. I think in grand scheme of things, since late September when PBOC held the press conference, all these easing measures that they announced late September, which were confirmed by the September Politburo meeting, telling us that this is from the very top. I think this is, compared to previous rounds of easing, more coordinated, more systematic across different ministries, different instruments. So from that point of view, not really a surprise.
But is it enough? I mean, we're seeing a slew of measures, stimulus measures, and yet, investors try to say it's not enough. What more needs to be done, you think?
Right. This question came up a lot in our client conversations, and it is a question that we need to qualify. Is it enough for what? We put out our latest views over the weekend. It's not going to be enough for China's medium long-term growth outlook, given the challenges China is facing. None of the stimulus would reverse the deteriorating demographics, and none of the stimulus is going to reverse the sort of rising geopolitical tensions. But is it going to be enough to stabilize growth? Is it going to be enough to give some confidence to very pessimistic investors? We think that might be enough.
So fundamentals have not changed. What would be enough to change the fundamentals? When you take a look at the economic data out of China, pretty lackluster, pretty sluggish. We have inflation close to zero. We have the likes of consumption still in question.
Yes, and I think that's consistent with why policymakers finally decided to do something a bit more forceful than what they were doing before. The inflation is not just a one-off. We had 1 month of bad data. Month after month, we see the weak inflation data. And I think yesterday the exports decline. We don't know whether that's just a typhoon or temporary impact, or is it something suggesting that growth in exports will be slowing going forward. So I think this is consistent in the sense that things are pretty challenging on the ground, and hence policymakers need to step up easing measures. And in terms of what do they really need to do, what would investors look at the package and say they really got it, they are going to solve the cyclical problem? I think property is front and center, how we are going to stabilize the property sector. In the Politburo meeting statement, there is a pretty clear signal that they want to stop the falling prices in the real estate market and trying to stabilize it. But we still haven't seen concrete plans of how exactly they're going to go about to address the issue. And local government debt is another issue that in Chinese property market, the transmission mechanism, not so much like in the U.S. through financial products, CDOs, and lending and financial crisis, but rather through local government financing stresses and contractionary actions by local governments, increasing fees and fines and so on. So we are hearing from Ministry of Finance at their press conference that they will be dealing with debt swap, debt resolution plan.
Right.
So I think those are the issues they need to address.
Hui, as you said, Goldman raised its growth forecast for China to 4.9%. That is still short of China's own 5% target. Does it matter if China fails to get that 5% target? Does it matter if it gets to 4.9? Is it just psychological, you think?
Look, when we look at our forecast, we need to do the math and add up all the components and benchmark to all the data, high-frequency official, before putting down a number. I think the government's target is not exactly 5%, it's around 5%. So I think 4.9, that should be considered as achieving the around 5% target. And this is really our upgrading from 4.7 to 4.9 was really because of the signals we're getting from the Ministry of Finance press conference.
Hui, thank you so much for joining us today. Hui Shan, Chief China Economist at Goldman Sachs. Still to come, HCL Tech CEO C. Vijayakumar will be joining us exclusively to discuss the Indian tech giant's earnings beat and, of course, its outlook on AI. Keep it here with us. This is Bloomberg. Welcome back to Bloomberg Markets Asia. You're watching India Focus, and India starts trading in about 6 minutes from here. We have futures pointing to a higher open. The Sensex up about 0.2%. Of course, India trading after its inflation accelerated at a faster pace than expected in September, perhaps justifying the RBI's caution as calls to cut interest rates grows in the country. In terms of the Nifty 100, it is currently up by 0.3%. Of course, it is still pre-session, looking for a positive day for India. And recapping those, India CPI are rising 5.49% in September from a year earlier. It is the quickest pace in 9 months. We're also tracking HCL Tech, by the way, profit helped by modest recovery in spending. The firm's quarterly performance showed broad-based growth on a sequential basis across geographies as well as verticals, excluding financials. In pre-market, HCL under pressure, currently down by about 1.5%. Let's get exclusively to C. Vijayakumar, CEO and MD at HCL Tech. Good to have you with us. The question really is what you deem as a sustainable pace of growth going forward in terms of revenue and profit.
This year, our guidance, we have revised from 3 to 5% to 3.5 to 5%. And we've had a good first half. Q1, we did a little better than expected. Q2 as well, we've done better than expected. So which has helped us revise the lower end of the guidance. And the discretionary spend has been under pressure in the past, but in Q2, we saw a good uptick in discretionary spend. not just in financial services, but across the board. And that's what helped us deliver a good set of numbers. We've delivered 1.6% sequential growth and 6.2% year-on-year growth on our overall numbers.
Can that discretionary spending on tech continue given expectations of a slowdown pretty much across the world? We have Europe in particular under a lot of pressure.
Yes, and that is precisely the reason why we are not extrapolating this improvement in discretionary spend to be something sustainable. We are being a little cautious. We want to see this over a slightly longer period of time before extrapolating this for the long term. As you know, there is geopolitics, there is still macroeconomic challenges in different parts of the world, and all of that tends to keep our customers a little bit cautious about their spending. So at this point in Q2, we saw a good uptick, not just in financial services, but across a number of sectors. And we're going to wait and watch, and we keep executing based on the demand that we're seeing from our clients.
How much confidence do you have in the U.S. economy? It is still pretty resilient, but there's also the risk of the U.S. election. How is that impacting the way companies look at tech spending in the coming quarters?
Honestly, I'm not seeing a major correlation between elections and the tech spend. I think tech spends are getting driven by the business priorities that every company has. And technology is a very, very key component for almost every business, for conducting their business, for their resilience, for their growth, innovation, for all the nice things. Technology plays a pivotal role. So I think these two, I see less correlation. And given there is a lot of interest in Gen AI and the art of the possible using Gen AI, and that's also driving a certain thinking, which is increasing the spend and the focus on these areas with our clients.
How about correlation between tech spending and Fed moves and central banks in particular? Here, we have expectations that the Fed may be a bit more cautious when it comes to cutting rates going forward. Might that impact the thinking of how companies spend on tech?
Yeah, I mean, it's. I think if you see the past cycles, I think. I mean, I've heard and I've seen the interest rate cycles moderating has kind of triggered some spending with clients, especially in banking, and I presume that will probably continue. And I think there are already signals that the interest rates, I mean, it's already gone down a little bit, and there is certain signals that it will go down further. So I presume at a high level, all of this should play into improving demand environment.
CVK, in terms of the sectors that might boost your growth going forward, which one might that be? Might that be telecom, media, tech companies?
Yeah, I think two broad segments. One is financial services. The second is what we call as TMT, which is telecom, media, and tech. So I think it's one combined vertical for us. And these two verticals look strong. And the life sciences and healthcare, especially payer and provider segment in the US, definitely there are lots of opportunities there. And across all other segments, there is a certain spend which is getting triggered because of Gen AI. Gen AI allows clients to modernize and retire their technical debts faster and in a more efficient manner. And there is certain spend which gets triggered around data and AI because of Gen AI possibilities. And also a little bit more focus on cognitive infrastructure, whether it is cloud or on-premise. So I think these three areas is where I see customers increasing their focus and subsequently the spend as well.
And we know that AI accounts for the most of the tech spending made by companies. Some are suggesting that, $1 trillion in the coming years for the likes of Meta as well as Microsoft. What assumptions are you making about AI tech spending, and what are you seeing on the ground?
I think our focus is a lot in transforming the tech services that we deliver to our customers. We have a platform called AI Force, which is focused on bringing all the efficiency levers for IT and business services within an enterprise. So that's a very important focus area for us. The second is HCL Tech Enterprise AI Foundry, which is focused on bringing data-led innovations. Data is in different shapes, forms, in different places. How do you bring them together, either getting the data to the LLM or make the language models access different data sources to get the right outcomes? So I think there is definitely streamlining the data layer is a big area. And the third one, as I called out, is the cognitive infrastructure.
You talked earlier about how you see no correlation between the U.S. election and tech spending. I'm just wondering if you see risks out of the U.S. election. Already today, we heard about how the U.S. is mulling capping AI chips from the likes of NVIDIA. What risks do you see from the U.S.?
I think it's a very broad topic. I would hesitate to comment on that.
Do you see the U.S. adopting policies which might impact players like you?
I don't think so. See, the technology is such a crucial component for every segment of enterprises, government, academies, all of them, and NGOs and SM, small and medium businesses. And the technology landscape is becoming more and more complex. So the need for specialized service providers who can help leverage the right technology solutions to meet the client's business requirements, I think that's a enduring need, and it has to be addressed. And service providers like us are in the center of addressing such opportunities. So I think it would continue, and there will be only increasing focus on these type of services as we move forward.
CVK, given the optimism, what are your growth plans? Are you planning to hire more? Because when it comes to attrition rate, we're looking at 12.9%. It is lower, but it's still quite high.
Yeah, I think instead of looking at the total hiring numbers, right now we are more focused on hiring specialized talent who have AI, machine learning, Gen AI capabilities, as well as a lot of commercial applications like SAP, S/4HANA. So it's those areas is where we are focused on in terms of hiring. So the absolute numbers may not be very high, but the type of skills that we hire will undergo some change. So I think our pyramid structure would change gradually to have more specialized skills. That's how this is going to evolve.
Thank you so much for your time today, C. Vijayakumar, CEO and MD at HCL Tech. And speaking of HCL Tech, I think you're aware they're trading right now in positive territory on the back of that better than expected numbers. Well, still to come, a fresh escalation in diplomatic tensions between Canada and India. We'll have the details on new accusations from Prime Minister Justin Trudeau next. Keep it here with us. This is Bloomberg.
I think it is obvious that the government of India made a fundamental error in thinking that they could engage in supporting criminal activity against Canadians here on Canadian soil, whether it be murders or extortion or other violent acts. It is absolutely unacceptable for any country, any democracy that upholds the rule of law.
fresh allegations from Canadian Prime Minister Justin Trudeau, who's accusing Indian diplomats of backing criminal harassment and violence against Canadians. Let's get more details on the escalating diplomatic dispute and bring in government reporter Sudhi Ranjan Sen. Sudhi, tension's been high since the murder of a Canadian Sikh activist last year. What is Canada accusing India of now, and how has India responded?
Well, the accusations that we saw from Canada are very, very serious. In short, they're saying that Indian diplomats under diplomatic immunity have, been involved in activities such as extortion, killings of Canadian citizens, and also coercion of Canadian citizens to work for India, collecting information and, meddling in the internal matters of Canada. Those are very, very serious. And we saw Canada over the weekend kind of wanting to waive the diplomatic immunity of Indian diplomats and question them over this. That kind of led to a very, very sharp reaction from India. India, first of all, issued a statement, and then by evening, as the RCMP was, doing a press conference, which is quite unprecedented, and giving out the details that their investigations have showed, India expelled 6 diplomats, including the acting High Commissioner, Canadian High Commissioner in India. So ties more or less at its very bottom between India and Canada.
And of course, India has said everything is on the table. What's likely to happen next?
Well, this is uncharted territory, because India and Canada does have a very strong relationship. There is trade, there is a lot of investment that comes in from Canada. We are not yet clear whether that is going to be impacted with the diplomatic relations. If we take a cue from the past, when relations in the past suffered, that did not really suffer the trade and investment, so to say. Although we saw visas getting, being suffering on either side. And why that is important is because a large number of Indian students go to Canada to pursue their higher education. It is one of the destinations that is very, very popular in India. Whether that is again likely to suffer is something that we have to watch very closely, as well as the investments that come in from Canada into India.
Sudhi, thank you so much for that. Government reporter Sudhi Ranjan Sen. Well, in the markets, Asia trending higher on the back of the gains that we saw overnight in the US. The S&P posting yet again another record high, 46th record high. Take a look at that. Pretty much green across the board, barring Hong Kong, which is currently down by 1.5%. It was higher just yesterday. In terms of the FX space, we're tracking the yuan, the yen in particular, inching ever closer to that 150 mark. And of course, a reminder that former President Donald Trump will be sitting down with our own Bloomberg editor-in-chief, John Micklethwaite, for an exclusive interview later. It comes exactly 3 weeks from Election Day. Catch that conversation at these times on your screen. That is it from Bloomberg Markets Asia. Horizon to Middle East and Africa is next.